Our guest says stock market valuations are high and discounts are hard to find. However, he argues that earnings growth is real despite the noise, and he's bullish on stocks for 2026. We're joined by Ryan Belanger, founder of Caro Advisors. Ryan, always great to see you. Thank you very much indeed for joining us.
Good morning.
Start off with the U.S. market. We do keep hearing that the valuation is full, but profit growth is a fundamental driver for stocks in historical terms, and you think that that's intact for now?
Yeah, I really do. I think we're in a new kind of era here with productivity gains kind of across the board. I mean, if you think of certainly most industries out there, people are getting significantly more productive. And as a result, that allows companies to run more efficiently and earn more profits. And it's not for every company, it's not for every industry, but most will see positive benefits from the development of the AI technology. And we think that's going to continue to push profits up in the future.
But you note that some jobs will go.
Oh, definitely. Yeah. I mean, it's change, and if you think about over the last few decades of innovation, jobs that were once, fairly regular jobs are now automated. But those people found new jobs and they learned new skills and they learned how to work with the new technology that needs maintenance and upgrades. And I think that's just, kind of how these cycles go. So I think, workers should be able to find jobs. I know it's a little bit of a soft environment at the moment. But for the people that are reinvesting in new skills and learning new ways to use this technology, then I think there are going to be plenty of jobs for everybody.
You say one headwind could be midterm elections in the United States this year, and often midterm election years are choppy.
I think so. That's just historically, and there's just a lot of political infighting, and it's confusing to see the vision, and people are distracted. They're running for campaigns. They're not out there, trying to make positive change in their communities. So I think it's just the natural distraction of that. Those elections tend to take people's eye off the ball a little bit.
And you just turning to the Fed, even though people aren't expecting a cut this month, there have been reductions. And you say, and I think we've heard this from other analysts, that typically when the Fed cuts and it's not a recession, the market tends to do well.
Yeah. I mean, this is something we've been saying for a long time. We call it a non-recessionary rate cut. So far, we haven't seen a recession, so that is well defined. And that's typically followed by a double-digit market move the next year. Overall, just generally positive. And just speaking of numbers and trends, if you start the year out with 5 trading days up, 5 of the last 6 years that has happened, and we've had positive markets. And then just a little bit more broadly speaking, the month of January, if that's positive, you get about a 68% chance that the year is going to be positive. And so if you're into those types of longer term trends, the start to the year that we've had would vision a nice positive year for investors. And so we're certainly hoping that's the case.
We have Canadian stocks hitting a record high today. Are you seeing opportunities in this country?
Yeah, I think so. I mean, one stock we've looked at, and I think we've talked about it in the past, is TD Bank. That stock has moved up quite a bit. It's kind of a sleepy stock for a long time, but I'm sure many Canadians are owning that. And there's just so much change going on with, certainly politically on how the countries are kind of interacting here. But, there's a lot of news in the energy space and mining. And so I think as investors, you just want to be broadly diversified. I mean, what we tell our investors is you just got to own a little bit of everything. Because look at this year, for example, small cap stocks are outperforming the large caps. And that's been an inverse of what's happened historically the last number of years. So, and actually mid caps as well are outperforming the large cap peers. So that's a change. And so any investors who dumped those exposures would be kicking themselves. And so we typically keep a broad asset allocation overall.
Yeah, TD stock hit a record this week. Would you be inclined to buy it with new money, TD Bank?
I don't, we tend to stay away from single stocks. We are, more using ETFs and funds to manage things. But if a client had a particular interest to own a stock, I think it's a relatively, a safe bet, banks in general. So I think you'd be fine owning that stock.
Just finally, we've got a lot of turmoil linked to U.S. President Donald Trump threatening to take over Greenland, kidnapping or detaining the Venezuelan leader. Do you think that's a threat to the market?
Always. I think these are just distractions. Geopolitical risks is the bucket we would put these under, and history is littered with them. And if you zoomed out of a long-term S&P 500 chart, you'd see hundreds of these things that have gone on, and yet, because of the ingenuity of the American consumer and just global capitalism in general, you get equity investors get rewarded for owning shares over the long term. And so if there is any opportunity by a geopolitical disruptive event, meaning stocks going down, we always urge investors to if they've got the time horizon and the risk tolerance, to try to take advantage of those opportunities of weakness.
Ryan, thanks very much indeed.
Thank you.
Ryan Belanger, founder of Caro Advisors.